Hello and welcome to Pro Trader Strategies Market Commentary for Thursday, May the 4th. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. Having that out of the way, let's get this on. Quite a bit of economic data today, but most of it is not that important. We have a lot of across the pond services PMI, but remember flash PMI, which we've already gone over, has already been released, which kind of takes away some of the impact of these latest services, final services PMIs for across the pond. So I'm not really going to delve into those, but we did get Great Britain's services PMI, and it came in at 55.8. Was expected to be 54.8, so slightly higher than expected. And remember, anything above 50 on those PMI numbers is expansion, so that has looked good across the pond, albeit a lot of them have come in under what was expected. They've all stayed above 50, which is expansion. So, and then here in the United States, we got our challenger job cuts came in at negative 42.9%. Not too bad there. And then we also got unemployment claims came in at 239,000, expected to be 245,000. So job cuts being lower, that is good for the overall, job unemployment claims being lower, good, showing that people are generally getting hired. Doesn't really show what the participation rate is in that one. We'll get that tomorrow with the non-farm payrolls. And then we also got here in the United States, the preliminary unit labor cost came in at 3%, expected to be 2.5%. That's good, showing that labor costs are going up, which gives buying power for the overall economy. So, and then later on today we have Mario Draghi speaking, which is the ECB president. So that could give us a little bit of indication as to the economic outlook over there. Anyway, on to the overall markets. We've got crude oil continuing to slide after basically going below that Fibonacci level that I talked about, the 38.2, looking at that 50 fib level coming up lockstep. Probably, almost at this point is a real factor. And right now, going back down to that volume node that I was talking about, I was looking for this to happen quite a while ago when we were breaking down below, remember, and then we had this massive rally. The overall market still continuing to slump for the last several weeks as we've seen a lot of demand from distillates and distillates and gasoline, which I talked about yesterday. So the overall market coming down and touching this value area low and kind of finding a little bit of support there, which is that high volume node we were talking about here. So crude oil finally coming to that point that I was looking for it to happen about a month ago. Anyway, on to gold. Gold really slumping, was down over $20 just not too long ago. We got below this 200-day moving average, and the market really started accelerating to the downside. It's still in an upward trend. As you can see, we are continuing to have higher highs and higher lows. That could be broken if gold continues to slump, but we'll have to see how that works out. The overall market's pushing higher, flight to quality, people pulling out of gold and putting it into the broader markets for the equities for that matter. Bonds down over a point, almost a point and a half right now, and below the 50-day moving average. So really slumping off, signaling higher interest rates going forward. Now yesterday we had the FOMC. They didn't do anything, left interest rates at 1% for the Fed funds rate. But a lot of chatter was going on in Twitter and elsewhere where people were talking about the probabilities of a rate hike at the June meeting were somewhere around 70 to 90%, which is way off as far as I'm concerned, because if we look at the August Fed Fund futures, they're trading about 98.90, which indicates that there's only about a 28% chance of a Fed hike by August. So the overall broader market not buying into that picture. I'm not really sure where some of these other media outlets were getting that number, but I tried to correct a few of them, saying, hey, the Fed Fund futures haven't moved a whole lot, and at best priced in another 4% probability of a rate hike, not necessarily on the docket. So that's only about, like I said, a 28% chance of a 25 basis point move by August. And there's two more meetings, June and July, in there that are also a part of that equation. So it's really looking like closer to December is where we're going to see that next 25 basis point move. So just for your information, keep your eye out on that. Then Dow Jones Industrial Average just off by about 14 points. Again, still stuck in the mud, really, just trending sideways. Not a whole lot to see here. The overall markets have been very tight. We've got NASDAQ up on the day by almost 12 points. Again, very tight range, not a lot of things going on as we are headed into tomorrow's non-farm payroll. E-mini S&Ps up 2 points on the day, but again, as you can see, these candlesticks are just like back and forth. One day we're up, one day we're down, one day we're up, one day we're down, and very tight range and settling very close to unchanged. Just a very boring market to try to put some trades on. This gives you even a better picture of a 30-minute chart on a 20-day pattern, but as you can see, the last, what is that, almost 8 days, 9 days, even 8 days, let's say, just stuck between, we could almost say from 2378 to 2390. That's 30 some points, which is just not very much for an 8 day, a full week, just basically sideways trend. Just not a lot going on there. One thing I wanted to point out, I haven't put on a trade with General Mills right now, but they did have rumors of a possible buyout or takeover, and the overall market's been slumping. But today rumors came out. It was actually slightly down on the day when those rumors came out, and as you can see, just a massive range and kind of settling down again, but implied volatility on that has really spiked. But going into the option montage, I was really looking to try and take advantage of some of this high implied volatility and sell some puts. I was looking at the selling like the 55 puts somewhere in there, but the bid ask is massive in there. It's usually not super tight for General Mills, but it is now just blown out. There's some markets where they're $1 wide, just pretty close to the market, which you wouldn't really expect. So I haven't really touched on that. There's a lot of volume going in there too. Looks like somebody sold a like 2,500 lot strangle around this event, but I think it's usually when somebody's selling that strangle, taking advantage of high implied volatility, they think that this rumor is nothing but just a rumor. There's no real credence to that rumor. Nobody really knows where it's coming from. Then on to AT&T. It looks like it's kind of bottoming out here. It's just getting a little long in the tooth for the most part. They did come out in line with expectations on their earnings. This just, to me, seems a little bit overdone to the downside, so I thought I'd try and take advantage of some of the high implied volatility. It's got about a 50-plus implied volatility. It's just slightly above what my threshold is for implied volatility percent. So I decided to go in there and sell some puts. So in AT&T, I went into the June and sold the 37 puts, and I collected 43 cents for that. So trying to take advantage of the high implied volatility, maybe a little bit overdone, and looking for at least a little bit of a bounce, maybe get out of that one rather quickly. With Disney actually looks like it's bottoming out here, but yesterday I pulled the ripcord on this. I did not want to let this trade go into negative. It's been a winner ever since I put it on, so I just didn't want to let that turn into a loser. It wasn't obviously as good a trade as when we were trading at those 52-week highs at 116, plus we're getting ready to head into the earnings event for that, so I decided to pull out of that, and maybe I'll set something up for an earnings trade later on. So with Disney, if you remember, I did this for one of our webinars on the poor man's covered call, and I did what I had originally done was the January 100 calls with the March 115 calls to cover that trade, and I paid $13.85 for that, and then rolled those March out to the April and collected another 42 cents, and then rolled those April out to the May and collected another $1.47. So all in all, I collected about $1.89-ish. So that lowered my overall cost basis on that from $13.85 to, let's call it, $12. So when I got out at $12.99, I made about 99 cents on that trade from rolling that out. And that's the beauty in doing that kind of trade. Despite the fact that the market was lower than where I originally had gotten in, I still was able to make money by staying mechanical and rolling those calls out. So that trade worked out nicely. Not as good as I would have liked to have seen. I could have picked the top, probably made a lot more money on it. But at the end of the day, it is very difficult to pick tops and bottoms. But as soon as I saw it breaking down below basically the 50-day moving average, I was out. So if you stayed in this trade, it looks like it's actually kind of bottomed out, and we might get a bit more of a bounce, especially heading into the earnings in a couple of days. But I'm out of that one, and I'm going to move on, maybe play a trade around earnings for that. So I hope that was pretty clear on how I worked that trade out. And I've been talking about it in daily market commentaries when I've done that, but just got a little confused on my notes there. So that's about all I got for you guys today. Tomorrow's webinar is going to be on earnings trades and how to be mechanical and defend a position that has gone against us, which everybody needs to know how to stay mechanical, how to stay with the process and increase your probabilities of success. So if you aren't signed up for that, go to protraderstrategies.com, sign up for it, because it is an imperative webinar to watch. All right, if you can't take that, take it easy.